Hello and welcome to this presentation on the impact that an effective cash management proposition can have on the regulated policies within your business. We've already produced separate short presentations on remuneration policies, centralised investment propositions, conflict of interest, treating customers fairly, and the financial planning policy. So in this short presentation we're going to turn it around the other way and just have a look at the positive impact that effective cash management can have on each of these policies. Okay, so we need to start off by understanding a few of the facts and principles around cash. And the first thing is that it's actually the largest asset within the financial services industry, yet it's the most misunderstood and largely ignored, mainly due to the complexities of obtaining the right information at the right time and the processes around for managing cash. And this is partly due to the motivation that deposit account providers have to maintain the lowest rates of interest paid to savers to enable them to maximise their own profits. There's also an impact of the fact that there's no remuneration to financial advisors for them helping their clients to manage their cash, or should I say there's previously been no remuneration involved in financial advisors helping their clients to manage their cash. And the other thing is, it's actually, when we look at analysis around the marketplace, and we have some big names that produce some analysis and statistics around cash, most of it is misguided or inaccurate. And so if your clients are exposed to using the accounts that are available to them, then the difference that this can make to the beneficial value of cash is massive. And some of the core points around this are shown here on this slide, because it is in fact possible for any rate of taxpayer to beat inflation with cash if their cash is managed properly. And the performance of cash has outstripped the performance of the majority of long-term investments held since January 1995, and this is because cash deposits continue to grow year on year, whereas the stock market's just been on a little bit of a rollercoaster ride. So it's peaked and troughed, and it's currently sitting back at the peak again for the third time since the turn of the century. So we've done some analysis and taken 5, 6, 7, 8, 9 and 10-year timescale portfolios starting on a monthly basis from January 2000, and it's now possible to demonstrate that cash returns has actually outperformed the FTSE 100 index in over 60% of those portfolios that have been measured. So as a result of these portfolios and these statistics and the performance of the global stock market, cash really must become a fundamental part of the financial planning solutions provided by financial advisors. Or at the very, very least, the financial advisor should undertake the commitment to inform the clients of what their opportunities are. And the only reason that this should be done is not necessarily to protect the client, but that is a product that will come out of this, but it's actually to protect the financial advisor, to mitigate the level of inherent risk that's being built up within their businesses, to help them to maximise the value of their business and also maximise the value of their client base. So let's start by having a look at the remuneration policy, and obviously there's going to be a natural link here through all of these slides, because no policy uniquely stands alone within a business. But basically the majority of remuneration policies and reward schemes are based upon selling new regulated business, and obviously the area which impacts upon cash is the collective investment products. So if your remuneration policy within your business requires clients to either be invested or remain invested, and offers no opportunity for your advisors to be remunerated by the management of cash, then you have a conflict of interest. You have an issue with treating customers fairly, and you're putting the client in a no-lose situation, because if their investment performance fails, they can easily claim their attitude to risk was not assessed properly, and therefore they are more likely to be compensated. Okay, so having an effective cash management proposition to underpin your remuneration policy is very beneficial for your advisors, your clients, and your business. So moving on to centralised investment propositions, now the fact remains here that it's very difficult to have an effective cash management proposition within your centralised investment proposition if it's not included within your remuneration policy, and obviously vice versa. But the reality is every client that has an investment with you or your business will also have cash on deposit. And if your client understands how to maximise the returns of their cash on deposit, it will also help them to understand the beneficial value of the longer term investment portfolio. And in doing so will mitigate a number of risks and remove a number of conflicts that the business is carrying, and will also remove the client's no-lose situation, because they will no longer be able to claim that they didn't fully understand the situation regarding the beneficial value of cash and therefore the corresponding risk return reward of entering into longer term investment based portfolios. From a TCF point of view, effective cash management complements every single policy. So let's have a think about an analogy here around property. There are times when people decline from purchasing property because the property prices are high, and there are other times when they can't wait to get into the market because property prices are low. Yet when we have a similar situation within investments and equities and global stock markets, it's not considered relevant for a client to either decline to invest or to divest at times when markets are high, and similarly the opposite when markets are low. And it's no longer acceptable to say that it's time in the market that matters rather than timing of the market, because for the last 20 years cash has outperformed some of the major global indices around the world. So to ignore cash is futile and will incur significant risk within your business. You need to mitigate this risk by looking at an effective cash management proposition. So already we're probably 2 minutes into this presentation, and we can see that we've already identified a number of conflicts of interest within the business that are created by the way the business is completed. And so let's consider this as well. There's a significant conflict of interest if your financial planning policy does not require the benefits of an existing pension scheme to be properly understood by the client before the transfer is completed. Okay, now we all know that this risk has been mitigated because there is now a regulatory requirement for this to take place, and for your client to fully understand the benefits of their seeding scheme so that they compare them clearly with the benefits of the new scheme. And we all know that failure to provide the above analysis not only significantly impacts upon the TCF policy, it also puts the advisor and the firm in a position where they accept full liability. So therefore, ensuring that this is done mitigates this risk and mitigates this liability. So consider now the situation relating to cash, and consider the key points that we talked about in the first two slides, where you can beat inflation, it's obviously secure, and it's outperformed the stock market at least 60% of the time over the last 15 years. So in this situation here, there is a significant conflict of interest if your financial planning policy, your remuneration policy and your centralised investment proposition do not require the benefits of cash to be properly understood before an investment is completed. So this risk needs to be mitigated by the requirement to make sure your clients do fully understand the benefits of their cash. And I think it's clear to see now that failure to provide the above significantly impacts upon all of the policies within the business, but specifically the treating customers fairly policy. So therefore, ensuring that this were done would complement this policy, would mitigate the risk, and will put the financial advisor and their business in a much safer position. So basically the results of all of this analysis and comparison needs to be bound together with the financial planning policy. And if you can present your financial planning policy where the financial advisor has the freedom to move money between cash and equities at any time and can generate commercial revenue at any time with that activity, then you have a far more viable proposition, and one which does not present the client with being exposed to unnecessary risk at any particular time. And the reality is that just because effective cash management is integrated within a business, it doesn't necessarily result in less regulated business being produced. In fact, our experience is that it results in more regulated business being produced. But being able to demonstrate that flexibility and that lack of constraint and control basically protects the financial advisor, protects the client, and more fundamentally protects the business. So it should be clear by now the complete value of effective cash management. Whilst currently it's not a regulated requirement in the same way that it is for pension transfer business, it's clear to see that it's a beneficial service that will add value to the client, to the financial advisor, and to the business. So the reality is financial services businesses may not experience high levels of customer complaints, but when it comes to sell the business, and this is seen with a number of key brands at the moment, the majority of financial services businesses are being undervalued, and the only question therefore remains is yours going to be one of them? So I hope you've enjoyed the presentation. Slightly more complex, this one over a lot of the others, but it's clear to see how a cash management proposition underpins all of the regulated business that financial services businesses typically engage with. So if you'd like more information, please contact us on any of the methods shown below. So thanks once again for listening, and we look forward to hearing from you.